It's great to have you with us as we track the markets on this Friday morning. A reminder, there's no regular trading in New York, the July 4th holiday. We, of course, had our Canada Day holiday. Outside of the celebrations countrywide, there's been a lot of enthusiasm in the stock market coming into today. We'd seen all-time highs this week for both the Canadian and U.S. stock market. Of course, we keep hearing about some of the uncertainties in the air, fresh commentary on tariff troubles, possibly for some countries around the world, plus how are central banks navigating all of this. Let's get some perspective from Pierre Ouimet, who is head of investment strategy at UBS Canada. And Pierre, it's great to have you back with us. And there's a lot.
Good morning, John.
Good morning. There's a lot for investors to digest these days. But I love when we get to these sort of these mid-year moments. We wrapped up the second quarter. So now as you look into the third quarter, what's top of mind for you and your team?
Well, right off the bat, we have the budget and the fiscal situation in the U.S., the fiscal situation in Canada. Then we got tariffs next week as well, and the outlook for interest rates, monetary policy, geopolitical issues. There's a whole bunch of stuff out there. I mean, it's this year's been exciting from that perspective. But we've had a melt-up in equity markets, which is, I mean, we often look at sometimes the corrections in the market. We say it's been a perfect storm to the downside. It's almost like a perfect storm to the upside right now. It's like, policy issues, budget issues, tariff issues, everything's coming to a head. And on the geopolitical side, it looks like things have headed in the right direction as well. And so there's a lot of enthusiasm right now in the markets. And I'm just afraid that they're getting carried away. I mean, maybe the big, beautiful bill will turn out to be the exclamation point to an intermediate top in the equity markets here.
Interesting. Well, I guess, some people have said in the short term, look, if there's going to be spending, that's the kind of thing that can be, helpful to the stock market. But I think there are so many people who are worried about the fiscal story in our country, in the U.S., and what that ultimately means. I just wanted to just add to the conversation because UBS has some data that would suggest that if you try to measure geopolitical risk, it's actually higher right now on average than where it has tended to be over the last 15 years. So we've got a stock market at an all-time high, but we've also got higher than normal perceptions around geopolitical risks. Is that correct?
Yeah, absolutely. It's a little bit mind-boggling that there's so much confidence in equities right now, particularly if you look at consumer and business confidence and the level of uncertainty. Uncertainty is at an all-time high still. It's come off a little bit, but it's still extremely high by historical standards. So it's I think the fiscal situation in the U.S. and in Canada, I mean, in Canada, it's even worse. I mean, yesterday it was the C.D. Howe Institute came out with their projections on budget deficits, which is kind of scary because they're talking about something north of $70 billion over the next 3 or 4 years, which is way beyond the scope of what the market's expecting. And in the U.S., it's the same type of situation. I mean, there's more pork, just more spending, and some of the important tax issues have been dealt with, but on the other hand, the deficit issue is still relatively important. And you look beyond, you look at the CBO, and they're talking about $51 trillion of debt by 2032, and so on. Of course, it's you look at the debt to GDP ratio, the overall debt, the U.S. government, it's like a moonshot. It just keeps going up and up and up, and it's almost going vertical. At some point, the bond market, and that brings us to interest rates, and the bond market has to react, I think. I mean, the term premium right now, or the risk premium on bonds is ever present, and as a result of passing that bill, actually, the 10-year Treasury tacked on 13 basis points as a result of it. So the bond market is aware of the dangers, but I think the equity market is, as usual, is kind of whistling past the graveyard to a certain extent. But I would say focus on interest rates and the bond market and what the Fed is up to. It'll be interesting to see whether they they cut interest rates at the end of the month here. That's another issue altogether. Yeah.
I'd also be interested to see how the market reacts to interest rates if it's not some kind of sort of incredibly aggressive mood, because who knows, maybe people will actually be encouraged by some modest cuts. But I guess like at the end of the day, when you talk to clients, given everything you've highlighted, what have you been recommending? Let's look at it through the lens of the stock market. Say somebody has got reasonable across the board coverage in equities. What have you been saying to clients?
We've been recommending, oddly enough, pretty well a neutral stance across the board, and it's probably a reflection of the fact that we really don't know how things are going to play out here. We have some idea of what's going to transpire. We think interest rates are going to come down, so fixed income market is still a relatively good place to be. But we're a little bit worried about the recent run-up in equity prices. We had a mid-26 target of 6,200 on the S&P 500. We've blasted through that. So it's, I think you have to be cautious on U.S. equities. There's been a rotation towards other jurisdictions, Europe in particular. We're emphasizing high quality, while it's also looking at dividend stocks, particularly in Europe, high-yielding Swiss securities, high-yielding European securities. We're launching a product here in Canada for our clients, which are U.S.-based high-yielding securities as well. I think that's the place where you want to be. You want some income along with some steady cash flow and earnings, and emphasize on quality. And we still believe the technology thing is the push towards technology is still going to be quite a significant, will have a significant impact. I mean, we can discuss that till we're blue in the face, but clearly it's going to have impacts on labor. It's going to have impacts on productivity. And I think that's being factored into the enthusiasm that we're seeing in equity prices now as well. There's this belief out there that AI, robotics, automation, quantum computing, all of that is going to lead to an extremely bright future. It's going to also lead to a significant improvement in earnings and for companies in terms of productivity. And that could well prove out to be the fact, but maybe here in the short term, the market is kind of overspending that to a certain extent.